Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Understanding Equity Swaps, an essential guide for today's investors. Equity swaps might sound complex, but they're a key tool for today's investors. At their core, these financial agreements let two parties exchange cash flows based on the performance of an equity index or individual stocks. So why would investors dive into equity swaps? They offer flexibility, potential tax benefits, and a way to manage risk without directly owning stock. In this video, we'll explore how equity swaps work, their benefits, and what you should watch out for. Curious about whether equity swaps could fit into your investment strategy? Keep reading to find out. What is an equity swap? Equity swaps play an intriguing role in modern finance. They are private contracts between two parties who agree to exchange future cash flows. One party pays a return based on an equity index or stock, while the other pays a fixed or floating interest rate. This setup allows both sides to benefit from specific market conditions without actually holding any physical shares. Mechanics of equity swaps. To understand equity swaps, think of them as a dance between two cash flows. One side agrees to pay returns linked to the performance of a stock or index. The other side pays a fixed or variable interest rate. These payments are often made quarterly or annually, depending on the agreement. For example, one party might pay the returns on the S&P 500 index, while the other pays LIBOR, a common interest benchmark, plus a margin. Here, the key is that the underlying assets never change hands. Instead, these swaps allow investors to gain exposure to equities or hedge risks without having to buy or sell shares directly. Types of equity swaps. When it comes to equity swaps, variety runs the gamut. Some common types worth mentioning include total return swaps. In this swap, the party paying the return on equities also covers any depreciation or dividends associated with the stock or index. This is useful for investors seeking full exposure to an asset's gains or losses. Pure equity swaps. Here, the swap focuses solely on stock appreciation or depreciation, avoiding dividends. It's a straightforward way to gain or hedge equity exposure based on price movements alone. While exploring these options, it's crucial to recognize how each type aligns with your investment strategy. Are you looking for full exposure or just price movements? Understanding these nuances can help frame your financial journey effectively. In the world of investments, equity swaps provide a unique avenue to manage exposure and risk. Whether you're an investor looking to capitalize on market movements or a business looking to hedge against price fluctuations, understanding these financial instruments is key. Key participants in equity swaps. Equity swaps bring together a variety of participants, each with their unique role and motivations. Corporations, hedge funds, and banks are the primary players. They all bring something vital to the table, contributing to the liquidity and functionality of these financial instruments. Role of financial institutions. Financial institutions stand at the center of most equity swap transactions. They act as facilitators, offering the structure and expertise needed to manage these complex swaps. Here's how they contribute. Platform provision. Banks provide the platforms that enable these swaps, ensuring secure and efficient transactions. They play a crucial role in linking parties. Risk management. Institutions offer risk management services, assessing and balancing the risks associated with swap agreements. They ensure that parties understand their potential exposure. Custom solutions. Tailoring swap terms to fit specific client needs is where banks excel. They adjust factors like payment frequency, underlying assets, and interest rates. Intermediary role. By acting as intermediaries, financial institutions connect counterparties who might not otherwise meet. This expands the market reach for swaps. These services not only ease the swap process but also foster trust between parties, making banks indispensable in the equity swap market. Involvement of hedge funds. Hedge funds often turn to equity swaps as a strategic tool. They employ these instruments for various purposes, primarily to enhance returns and manage risks. Leverage. Hedge funds use swaps to gain leverage, which amplifies potential returns without needing to hold the physical stock. This can magnify profits, though it also increases risk. Short exposure. Equity swaps allow hedge funds to take short positions without borrowing shares. This strategy helps them bet on a decline in stock prices efficiently. Risk hedging. By using swaps, hedge funds can hedge against market volatility. For instance, they might engage in swaps to offset positions in their portfolios that are highly sensitive to market swings. Cost efficiency. Equity swaps can often be more cost-effective than direct stock transactions. This is due to lower transaction costs and the avoidance of certain regulatory fees. In essence, hedge funds view equity swaps as versatile tools. They can adapt these instruments to fit varying market conditions and goals. This flexibility is a driving force behind their popularity among hedge funds. Benefits of equity swaps. Equity swaps offer investors a range of advantages that can enhance their financial strategies. From tax efficiency to leveraging capital, these instruments provide unique benefits that can't be overlooked. Tax efficiency. Explore how equity swaps can offer tax advantages compared to direct equity ownership. Equity swaps can provide significant tax benefits. Unlike direct equity ownership, equity swaps allow investors to avoid the capital gains tax that would typically apply if equities were held and sold. This means you can potentially defer taxes and keep more of your money working for you. Why pay more taxes than necessary when there's a straightforward way to manage your liabilities? Moreover, the payments received from an equity swap are often treated as income rather than capital gains. This can be beneficial if the income tax rate is lower than the capital gains rate, depending on your jurisdiction. It's like having your tax cake and eating it too, as it allows for skillful navigation of tax responsibilities while investing. Leverage and capital efficiency. Examine how equity swaps allow for leverage and efficient use of capital. One of the standout benefits of equity swaps is their ability to facilitate leverage. With equity swaps, you can gain exposure to a large volume of equities without the need for upfront investment. Think of it as borrowing the market's muscle to lift your financial goals without tying up large amounts of capital. Maximize returns. By using leverage, even modest movements in the market can result in significant gains. It's like a magnifying glass on your investment strategies, amplifying potential returns. Lower initial investment. You don't need to pour all your cash into buying stocks directly. Equity swaps allow for access to the same market movements with less capital. This frees up funds for other opportunities. Why let your cash gather dust when it could be working elsewhere? Flexibility. Equity swaps are tailored to suit your financial targets, allowing for adjustments as market conditions shift. This ensures your investments remain aligned with your strategy without needing constant juggling of positions. In essence, equity swaps present a smart way to manage both tax and capital efficiently, offering you more control and flexibility in your investment endeavors. Risks associated with equity swaps. Engaging in equity swaps comes with a series of risks that investors must navigate. These agreements might seem straightforward, but they hold potential pitfalls. Understanding the risks involved is key to making informed decisions. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.